All right. Yes. Perfect. So first of all, what did we go over in the previous video? We went over order flow. And in the first video, we went over market structure. They assist us to knowing where we can see that entry pattern. So if we look at the foundational levels again, then we went over bias, narrative, boundary, target, and context. Then we had entry pattern. That is where market structure comes in, and also order flow. And then risk management is also where order flow comes in. Now what we are going to do is, again, go over that order flow, as in the basis is about order flow and market structure. Now we are going to look at, all right, which low, which high is essentially protected, which allows us to then have a very easy entry pattern, and the risk management becomes quite easy then as well. So what do I mean by that? Well, if we start all over again here on EU, first thing we do is look at the monthly time frame. And on the monthly time frame, we were overtaking this monthly fair value gap. All right, nice. Then if you go into the weekly, did we have weekly context? At that moment in time, not yet. It was in this moment in time, not yet. All right, interesting. So we can go into the daily to look for daily context. Then right there, we had daily context right there. So the first thing we need to go over here is that there is protected lows and protected highs. In this moment in time, based on order flow, what is the protected low? The protected low is right there. That is the protected low. So if we want to continue higher, then we are likely not going to take this high likely not going to take this low right there to then continue higher. So what is the discount rate that we can push higher off of? That is the fair value gap that we are having right there, towards, of course, the premium rate. Now, where can we come into the daily fair value gap, etc.? All right, that is not super clear. So that is also why we don't use the daily right there to enter. So we are not going into the daily to enter something like this. You could do that if you're a position trader, but overall, this is not something I personally would do. So what do? We are looking on the lower time frame to refine another low on where we can expect that low to hold. So what do I mean by that? If we look at the daily, we know that this low is now protected. So somewhere in this area right there, we are likely going higher, somewhere in that area. Now, of course, we already know we have a great indication of where we can go higher from. And this is also something we're going to add on to. But the very basics is we are going higher from somewhere in this area right there. If we know that, then now we need to refine that low again that we need to enter off of. That is basically all you're doing in your trading. You're constantly refining the low or refining the high. So refining the protected high, refining the protected low to enter off of. So here, what is a protected low? A protected low is in that bias, in that narrative, etc., is a low that is responsible for a fair value gap higher. That is a protected low. So if we go into the 15-minute time frame again, like we did yesterday as well in the previous video, then we are coming into that daily fair value gap, into this daily fair value gap, into the daily discount rate that is sitting right there. And we had this premium rate that is sitting right there as a target. That created, again, our context. All right, in that context, can we now refine those lows again? Well, if we look at this, then we had the ST. Again, we had the displacement into the PD array, and the displacement out of the PD array. All right, this might be a protected low at that moment in time. How do we get that confirmation? By using a re. So that re is, again, that new order flow leg higher off of the ST. So here we get the re right there. Now we have done two things, because now we know that at this moment in time, the ST happened, and once the ST happened and we use the replay tool, we have an idea what the protected low is at this moment in time. The protected low is now this low, ideally, and you can refine that even a little bit more towards this low right there. Because if this low is going, then of course this low is also going, and this low was actually responsible for the swing, for the fair value gap to be created right there. So we understand here that this is now the protected low, most likely all right, since we use a 15-minute ST plus re, since the 15-minute, we require a little bit more confirmation than just one singular ST, we wait for a re. Right there. All right, now we understand that this is our re, our new order flow leg higher. So now what is the protected low? The new protected low is now this low sitting right there. Do we have anything above those time frames, above the 15-minute time frame, that is below this low that it can sting back into? Because all we're doing right here is, again, we had the monthly in context. The weekly was also in context. The daily was also in context. So the daily right here was our PD rate to trade off of. So we knew, all right, it's likely not going below this low that we saw right there. So then we can refine it. All right, what is the discount rate that we are continuing higher off of? Perfect. It's that daily fair value gap, most likely. Now we need to find the lows that are protected, that are coming out of that daily fair value gap right there. When we have that, then everything is in context. So a good trade right there, and the examples we are going to show you right here, is where everything is in context. Everything is in context. Because here, the daily allows us already to know that the 4 hour is in context already. So the 4 hour is not something you need to trade off of because the daily rules right there, because it's on the time frame above us. So on the 4 hour, we just need to look if there's a fair value gap below this low right there. Well, likely not, right? Likely not, because that is, we just came into those lows. Perfect. On the 1 hour, is there something? No, there's no fair value gap below that 15-minute order flow lag, which means that the 15-minute is in context of the 1 hour and the 4 hour, because an order flow lag right there is strong. As in, an order flow lag is high probability. What is an order flow lag again? Is that swing low right there that creates that fair value gap. But the order flow lag is not high probability if there is a fair value gap on the time frame above it below that order flow lag. So that is also what we're going to show examples on. So right here, this is now what? This right there is very simply said, your entry. All you are doing on the analyst phase is you're finding constantly the protected highs, protected lows. Where can we continue higher from? Where are we likely not coming back to? All you are doing in the execution phase, what are the protected lows? What are the protected highs? You're doing the exact same thing as in the analyst phase. The only difference is that you're now pulling the trigger and that you now all of a sudden are in a trade. So there are emotions involved. You now have to sort of do your risk management, etc. Those are all stuff we need to take into account. So that is exactly what we are doing. We're constantly refining the lows that are protected, refining the highs that are protected. Once we have that and everything is in context, because basically what we call that is context, then that right there is your entry pattern. So we're going to show a lot more examples to fully clear that up. So right here, at this moment in time, that is your entry. Why covering this low? Is there a reason to come back below that low? No. Can it sweep that low sometimes? Yes, it can, because again, that is the last line of defense. The last line of defense is still a PD rate, as in it's still a discount rate that we can continue higher off of. But the probabilities of sweeping a low when we have a fair value gap in the lag are extremely low. They are extremely low. So the probabilities of that happening is very low in general. So right here, if we were to target something, and targets again is what we're going to go over, target a 1 to 2, then this would be your trade right there. With your entry pattern just being in that fair value gap, just being the first fair value gap that we encounter right there. And then eventually, what is the new protected low right here? Well, first we need to again zoom out, because we need to zoom out and see what the 1 hour is doing. On the 1 hour, we are doing what? On the 1 hour, we are now creating this fair value gap higher right there. What was the swing low that was responsible for that, for the creation of that fair value gap? It's this low right there. So this low is now, again, it's the same low as on the 15-minute. That low is your refined low. As in that low should not be traded below before we continue higher. So this right there on the 1 hour would be now your entry, because this is now your protected low to then target a 1 to 2, simple 1 to 2, or even the context high right there. And from there, we go higher. What is after that? Your protected low. At this moment in time, this low, right? This fair value gap and this swing low. But what did we do? We took context high right there. So this is not an entry anymore, because we took, very simply, we took context high. So you want to take a step back at that moment in time. So this low, yes, based on the premise that we just went over, could be protected, but you want to take a step back right there because we took context high. So you want to be very careful and read price action. That's all things we're also going to go over right there. Now, let me go over the next example, which again is the same examples that we went over yesterday as well, because they were great examples and we can build onto that idea. So at this moment in time, we had a little bit of a different context. We had the weekly fair value gap that was sitting right there. This weekly fair value gap. So the thing we saw on the previous example was daily usual context. Here we are creating unusual context, or potentially usual context of the weekly fair value gap higher. But in first instance, it is unusual context. Because on the daily time frame, we see what? On the daily time frame, we remove the previous example, we had this. We were following through on this daily context right there, daily discount array, towards the daily premium array that is sitting right there. Once we did that, we left a very small fair value gap behind right there. All right, we can wait another day. And at this day, we need to anticipate, because that day right there, on the 1 hour, on the 4 hour, we're just seeing bearish price action. All right, once we see that ahead of London, what can we do? We can try to get involved. So where is the usual context right here? To target then the weekly fair value gap sitting right there, which eventually we deliver into. Then right there, what is the usual context that we can create? Well, on the 4 hour, we have this 4 hour fair value gap right there. But before we created that 4 hour fair value gap, we had something different, because we had 1 hour fair value gap sitting right there that we can continue lower off of. That 1 hour fair value gap is now where we can go into the 1 minute time frame. So let's take it a step back again, because what did we do right here? We were constantly refining highs on where we are not trading back towards. So what does that look like? On the daily time frame, the first thing we saw, all right, when we have some bearish price action right there, we can create unusual context to trade into that weekly fair value gap. That creates that bias, narrative, etc. So at this moment in time, we had this high that is likely protected until we deliver into the weekly fair value gap. And then it switches around potentially. So here on the 4 hour, what is now the protected high? Well, this swing high created that fair value gap right there. But at that moment in time, once we came into the 1 hour fair value gap, this was not a fair value gap just yet, as in it was not created yet. We had the expansion phase, but it was not actually created yet. So here, right now, you could argue it's the same high. So if we go into the 1 hour time frame, all right, it's this high again, right there. That is the protected high currently. So we have already refined where we should not come back towards. So right now, it's all right. We are going lower off of something in here. That can be the lower fair value gap, can be that fair value gap, can be the order block, can be the swing high. Now that's a lot of choices, right? And it is. I completely agree with you in that one. But that is where time comes in next. That is where we're going to refine which PD array are we going to trade into and when are we going to trade into. We are going to be very accurate with knowing that. So don't worry, that will come. So right here, we could get a great indication, and this is not a crazy thing, as in we are coming into that fair value gap right there, and we could have known it at that moment in time because of time, which is the next thing, again, that we are going to go over later on. So right there, this is now the refined high that is essentially protected. So we are not coming back above that high. Well, where are we continuing lower from? A premium array in that leg lower. All right, what is the confirmation time frame of that 1 hour PD array? We can use a 1 minute ST plus re. So on the 1 minute ST plus re, if we go into that PD array, then what do we actually see? We see not the previous ST, what we went over yesterday as well, but if we go over the fair value gaps lower at this moment in time, then we have this fair value gap lower right there, and then we have this fair value gap lower right there. That creates the 1 minute ST plus the 1 minute re. That again is a lower probability ST overall. And also at this moment in time, what do we create on the 5 minute? That is what we need to take into account. Because on the 5 minute, what are we doing right there? On the 5 minute, we have this fair value gap sitting right there. That fair value gap got created when? Let's see. This candle is 8:35, so that candle closed at 8:40. So the fair value gap got created at 8:40 right there. So let's dive into the 1 minute to see what is happening. On the 1 minute, the fair value gap got created after this candle right there, the candle close, meaning that this fair value gap lower on the 1 minute, is this now your protected high? No. Why not? Because it's not in context of the 5 minute right there, which means that overall your protected high is still this high sitting right there. So if you were to enter off of this right there, which is it's a completely valid entry, but you are not covering this high right there simply because it's not protected, because there's a 5 minute fair value gap right there. Now, we did not come into the 5 minute fair value gap, but that is when you can see price action like this, where we're sweeping legs with fair value gaps in them. Because what did we go over in the previous example? We said order flow legs, so swing highs, swing lows that have fair value gaps in them, they are order flow legs. Those are high probability in general, unless the exception to that rule is if they have a 5 minutes or on the time frame above it, a fair value gap above that order flow leg or below that order flow leg. And again, on bearish situation, if they have on the time frame above it, a fair value gap above that order flow leg, then of course that order flow leg on the 1 minute time frame, in this case, is low probability. That is what we need to understand. So right here, this is where you now would cover, well, what is the protected high here? The protected high is that high right there. Do you need to cover that wick all the way? This is also where the refinement comes in, so don't worry, it's also something we are going to go over. You can cover the body right there, the body of the candles right there. As long as you cover that fair value gap and you take into account that we can sting into that to then continue lower. That is very important. So right there, you take an entry of the 1 minute ST plus re, but you take into account the 5 minutes still, because you know the 5 minute is the protected high, not the 1 minute right there. That is very important. Which on the 5 minute, if we take a look, on the 5 minute, we had a few things right here. And we had a new fair value gap being created right there, and which we eventually continue lower off of as well. So we have this fair value gap, we have that fair value gap, and we have that fair value gap. Now, this is a little bit of a more difficult entry. Why is that? Because this right there is the protected high currently. So if we were to enter off of this lower fair value gap, then we would take into account ideally everything that is there, which leads to, yes, a great entry overall, but it leads more so into a swing trade than into a day trade. So that is something we also need to take into account. This is also something we'll touch on later on when we get into the details overall. But this is definitely something we need to take into account. Where right here, this is, again, don't get me wrong, this is still a great entry, but there are different reasons on why I personally would not take that. And the reason for that is because it becomes very difficult here to go break even. Where if we use the higher trade right there, it's a little bit easier. With a more accurate entry, it is easier to go break even. It is easier to manage your risk. So yes, we can just get in. That is true, as in if you have your higher time frame analyst and it's extremely high probability, then I always suggest, all right, let's get in. Then just capitalize on that move. It doesn't really matter how you do it as long as you get in. But it is important to understand that the different entry types, they lead to different types of risk management, which is the next video that we're going to go over, the different entry types. The first thing we need to understand is where we are placing our entry most likely, where our stop loss most likely is going, the basics, before we move into that. So now I want to go over the next example, which is again GU. So on GU, we saw on the 1 hour time frame right here, which we also talked about yesterday. Then at this moment in time, we had the monthly sitting, and if it wants to load, that would be awesome. On the monthly, we had this monthly fair value gap lower. Now at this moment in time, again, the monthly candle wasn't that high just yet, but on the monthly, we saw this fair value gap lower, which created this high right there that is likely protected. Now, of the monthly, this is a little bit too much, right? This is a little bit too much. We are going lower from somewhere around there. That is a little bit too much. It's just a little bit too much area to cover for our stop loss, etc. This is not necessarily an entry we want to take. All right, so how can we get, again, everything in context? The monthly here is in context. So the monthly is checked off, which usually also means that the weekly is already checked off, because the weekly right there is already in context of whatever the monthly is doing. So the monthly can continue lower off that monthly fair value gap right there. Perfect. Then on the daily time frame, and we can already get a greater indication that we do not want to come back above that monthly fair value gap high, most likely. So we want to go lower off of somewhere inside that monthly fair value gap. Perfect. How can we refine that? On the daily time frame right now, what are we doing? We are creating a daily ST where this high right now is protected. Why is that? Because that swing high created the daily fair value gap lower. So now we have a much better indication where we went from this protected high to now this protected high. So in order to fully understand that, we have just simply refined. So made the area smaller on what we want to trade off of. Making that area smaller leads us to be day traders. Because if you're a position trader, then this right there on the monthly fair value gap, yes, this potentially would have been an entry. Who knows? Would have potentially been an entry right there. And I could teach you that for sure. We could go over that. But I think most people here are, and generally speaking, because you can also do this, but generally speaking, most people here are, I would say, maximum position traders, which I would say daily entries, and then going into swing traders, day traders mostly, and then even scalpers, where we have a lot of people as well. So in order for us to be that, do we take this entry right there? No, we need to refine the area on where we can expect prices to come back to, because that is the very basic definition of being a scalper, which also takes more effort being a scalper. So if you are a scalper, then you would more so focus on one instrument, because you constantly need to monitor the highs that are protected on every single time frame, if that makes sense. So here we have now refined the area to where are we going lower from? Well, somewhere here, somewhere right there, because that is the protected high right there. So somewhere in this area, that is where we are going low from. All right, how can we now refine that again? Well, we have the daily fair value gap right there. So likely we are also not coming above this daily fair value gap sitting right there. But can we now get that confirmation again to refine it even more? On the 1 hour, if we come into that daily fair value gap right there, we have our ST. Perfect. Because now instead of the whole daily fair value gap, the daily fair value gap has now been refined, because now this is the protected high right there. So now this leads to what? This leads to a potential entry where we can enter off of this fair value gap, can enter off of that fair value gap. Again, which fair value gap do you enter off of? All entry types that we are going to go into. So right here, what is the protected high? This high sitting right there. So that is our stop loss. So right now, we target a 1 to 2 to continue lower overall. And that is where we eventually look to target as well. And that is what we essentially are constantly doing. So inside here, inside this 1 hour fair value gap that we had right there, what could you do again if you are a scalper? Well, this protected high right there is a little bit too much. As in, if you are a scalper, that this position right there might not be the one you want to take because you want faster price action, etc. All right, perfectly fine. We can arrange that. And we can arrange that right now by focusing on, let's find a new protected high. So if we want to find a new protected high, then right there of that 1 hour, we can now go into the 15 minute, we can go into the 5 minute, and let's see what is the protected high right here. We have this potential ST that is sitting right there, the first protected high. Then eventually, because the time as well, time is not in our favor right there, eventually we are creating lower prices. Now this was already a protected high right there on the 5 minute. 1 hour PDRA, 5 minute ST. So that right there would have been your potential scalp. And if you wanted to go into the 1 minute, hopefully I can, then right there, you would say, all right, what is now the protected high? We have this fair value gap lower right there. Then this becomes the protected high. Then we have a new fair value gap lower off of that as well. This potentially becomes the protected high. But at a certain moment in time, we are creating a 5 minute fair value gap again. So we have to take that 5 minute fair value gap right there into account. Because if we don't, then we see on the 1 minute time frame that the 1 minute order flow lag eventually becomes the high or the low of an actual fair value gap that is on the time frame above it. So what does that look like? Well, here on the 1 hour right there, let's see if we can find that example. Here on the 1 hour, we have this fair value gap right there. This fair value gap, and we also have this fair value gap. Let's see both of these lows of the fair value gap, what they are. So on this right there, this low of the fair value gap is again just basically that low. This low of that fair value gap is basically that low right there. So if we go into the 5 minute, and we might even need to go into the 1 minute right there, then what do we see? We see that the high of this order flow lag right there, because we have a 5 minute order flow lag lower with that 5 minute fair value gap right there. This order flow lag is just simply the high or the low of a fair value gap right there, which of course makes it quite tricky because we say order flow lags are high probability, etc. Yes, but if there is on the time frame above you a fair value gap above the order flow lag or below in bullish situations, then this is not protected. So right here, this is, again, it's not in context right there. That is very important. So on the 1 minute even, you can again see the same thing where we have this order flow lag right there. Eventually, of course, we trade into it. And that again creates that order flow lag. This is not the best example right there. That again creates the order flow lags, which are just simply not protected because they have on the time frame above them a fair value gap above them. So they are not in context. That is what we need to understand. Where if we take it one step back, then let's delete all this. On the monthly time frame, we had this. On the monthly time frame, the protected high was this high, and we could continue lower off of this premium array. So the monthly check was in context. Monthly in context. Then monthly in context most likely also leads to your daily and your weekly, or at least your weekly being in context. Because when you have monthly context, you usually don't have weekly context. When you have weekly context, you usually don't have monthly context. They switch usually. So right here, all right, this is also in context because the monthly is already in context. And when the monthly is already in context, then this already is in context, the weekly. Then on the daily time frame, we can now see, all right, we want to refine that high a little bit. Then here, the daily is in context because we have that daily premium array, which means that the 4 hour most likely is already in context because every 4 hour fair value gap that we had right here is not relevant, right? This 4-hour fair value gap is not relevant because we have a daily fair value gap above it. So the daily fair value gap is relevant. That is when we can now look at our entry pattern, which on the 1 hour right there is this fair value gap and fair value gap below that as well, which means that the 1 hour is also in context right now, which means that all time frames are in context because the 4 hour is in context here, the daily is in context, the weekly is in context, and the monthly is in context. So every single one is in alignment with each other right there to say we are continuing lower. And if we are continuing lower, then this right now is our protected high that we are not trading back above. So this is extremely high probability to continue lower with this protected high right there. And that is essentially all we are constantly doing. So let's go over one more example and let's go over Canadian dollar CHF. With Canadian dollar CHF, again, what we went over last week, in the previous video as well. So yesterday we saw this weekly fair value gap and we had this low right there. All right, that created the context. So let's take this back one step to fully understand what are we doing. On the monthly, this was our protected high right there. If we wanted to continue higher and we create unusual context by not creating that bullish fair value gap, then what does the protected high become? The protected high is now this high. Well, it's very close to each other. Let's refine that a little bit more. On the weekly, we can see we came into a fair value gap right there. So what does that mean? That means that right now, the swing high, that swing high is now protected because that leads to a new fair value gap right there. So we have refined the area to where we want to continue lower from to now this area. All right, perfect. We can get a great indication by the fair value gap. That fair value gap, let's refine the area even more. Then on the 1 hour right here, we went over this situation where we had the first fair value gap lower right there. Let me replay the price action. We had the first fair value gap lower right there. All right, now most likely if we want to continue lower, then the high that is protected is that high, is the ST high. It's the potential intermediate term high that we are creating right there. Perfect. So here we have everything in context again. Monthly, weekly is in context. Perfect. 1 hour is in context. All right, everything again is in context. So once we have this breaker right there and we want to refine the high that we want to continue lower off of potentially a little bit more, then on the 1 minute, what do we see? On the 1 minute, we can see and we can refine the high even more. 1 hour PD rate, 1 minute ST plus RE. So this 1 minute ST tells us, all right, perfect. So now likely the protected high is this high if we want to continue lower. Because this high has everything in context right there. So if we want to continue lower right now, then we can protect that high. Now let's wait for this ST. All right, that ST plus that RE. Sorry, we already had the ST. The ST right there, and then this RE that is sitting right there. All right, now we're getting very close to an extremely refined high. Could this now be the protected high right there? Because that is our RE. That could very well be. So let's see here if this fair value gap is a fair value gap on the 5 minute time frame, because that is now the only thing we need to take into account. 5 minute time frame. Let's see. It is not a fair value gap. So there's no fair value gap above this 1 minute order flow lag that we have established as the RE. So that is great to know because that allows us right now to cover this high right there as our stop loss. Do we need to do that? As in, would it make a huge difference if we just covered that to just be certain? Would it make a huge difference? It's just understanding right here which highs are actually protected, which high you would not expect price action to come back to, which highs are there to hold, to place your stop loss above. So right here, this is where your entry would be because the fair value gap lower, and your stop loss right there, targeting a 1 to 2. This is scalping. And you can see that scalping, all we did right there is we are refining the highs and refining the lows to the protected highs to the 1 minute time frame, which takes a little bit more time. It's probably not going to happen every once in a while because it takes it takes a little bit more effort as well to find those highs and to find those lows. That is why if you are scalping, focus on one instrument only. So this right here is how you would scalp. It's still incorporating the higher time frame because for the 1 minute to be a high probability, we needed to know. So let's reverse engineer this right here. In order for us to know if this high right there, if this high would likely hold, we needed to know if there was something above this high that we could come into. So if we went into the 1 hour, we saw that on the 1 hour, we had this high right there and this premium array that we could continue lower off of. All right, but in order for this 1 hour to be in context and to know if we are not going above this high, we needed to know if there was something on the time frame above us to trade into to be in context again. So if we went into the weekly time frame, then we saw this weekly high right there, and that weekly high led to that weekly fair value gap sitting right there, which now we know, all right, so that 1 hour can indeed be protected because it's coming off of a previous PD array. So right there, now we need to know, is this high protected right there? Well, if we went into the monthly, then we could see, yes, because on the monthly time frame, there's no fair value gap above it. So everything leading down to the 1 minute is protected, which makes that a high probability scalp. So that is why I always mention, in order for you to be a scalper on the 1 minute, you need to know exactly what is going on the higher time frame. Yes, the higher time frame is extremely important to know what is happening on the 1 minute time frame. Because otherwise you are going to get blindsided and you are not going to know where the 1 minute fair value gaps will hold. Because the 1 minute fair value gaps will hold when everything there is in context with each other again. That is the highest probability. So this is again touching a little bit more in depth order flow and why we use it, because all you're doing as a trader, depending on which trader you want to be, if you want to be a day trader, it would be a little bit different. Why? Because you're not refining a lot of highs. You're refining less highs than a scalper. Where a position trader, you're refining even less highs before you go into a trade. Where a swing trader, you're sort of in the middle, right? You're sort of in the middle. Where, yes, you refine some highs, but less than a day trader and more so than a position trader. So depending on the trader you want to be, depends on how many highs, how many lows are you going to refine. So how many protected highs, how many protected lows are you going to need to find before you enter a trade ID? And that leads to your entry pattern, your stop loss, and eventually that also leads to your risk management. Because if we go over risk management right here, a little short bit, then we saw the 1 hour. So the 1 hour right there, we could already say the stop loss is above this high right there. Now, this would not be an entry, but if that was right there, then that would be your stop loss right now. All right, well, how can we know right now when to go break even or when to place our stop loss a little bit lower? Well, once we create a new protected high, this protected high, the only thing we need to take into account right now is, again, is there something, a fair value gap, above that order flow leg lower? On the 4 hour, no. Which means that this 1 hour fair value gap is in context. So this right now can be your refined stop loss or your break-even level right there, which is exact same thing you would do on the 1 minute right there. So on the 1 minute, let's take a look right here. On the 1 minute, we came into, again, the 1 hour PD array. This, at this moment in time, is protected high. Then we talked about this potential entry with this protected high. When can we go break even? Well, we have this new swing high with the new fair value gaps lower as well. All right, let's take a look if there's nothing above this high right here that we can continue a lower from. So on the 5 minute, are we in context right now? On the 5 minute, let's see. Yes, there's no fair value gap here. The fair value gap on the 5 minute is this fair value gap right there. Then eventually this fair value gap right there, which means that right here, there's no reason to come back above this high on the 1 minute, which allows us right there to go break even, or to at least refine our stop loss towards this high right there, and potentially even going break even if we entered off of that. Because is there a reason for price to come back into the wick right there to continue lower? Not really. So that would then be a break even right there using the same exact thing. So this is what you do on your analyst phase. Voice correct. This is what you do on your analyst phase again, but this is also what you do on your execution phase, because in the execution phase, you are basically doing your analyst phase. You are now just pulling the trigger. That's all there is. So the analyst phase is the foundation of everything. It's everything. And that's why it's so important, because the execution phase is an analyst phase with now an actual entry. So the most important part right there becomes the emotions that are getting involved, because all you're doing is you're doing the same on the analyst phase. So how can it be difficult? Because your emotions are in the way. That is where psychology also comes in. So this is very important to understand. And this is, of course, what we are going to touch on way more in depth. All right, perfect. Thank you.